everyone. Welcome to another Viking webinar. We're about to launch our 30-second deal. I'm really excited. And today I have two good friends, Judah Fold, our Vice President of Acquisitions, and Chris Paranello, our Vice President of Investor Relations. So, guys, it's interesting. 10th year anniversary of Viking, big deal. And then doing a really cool deal launch here.
Yeah, each deal that we do seems to have its own kind of unique nature to it, but this one in a lot of ways feels appropriate for the 10th anniversary. Excited to tell all our investors about it. And there's some, old, some of the good stuff they've always seen in the Viking deals and some new as well. So I think it's going to make for a fun webinar.
Yeah, absolutely. Chris, what do you think, man?
Yeah, incredibly excited about this one. The area is prime to really focus on and doubling down in this area with the Peoria Gateway project. It's exciting.
Yeah. So, the big, beautiful bill passed, some big positivities for real estate. There's a lot of traction in rent growth now. And though there was some turbulence and a little bit of volatility for the last couple of years, we seem to be at the point where it's starting to become more of a buyer's market and there's a lot of opportunity in the next couple of months to couple of years, actually. So, Judah, you're on the ground. What's your sense of things?
We look for, there are all different kind of indicators we like to point to. One of the ones I'm focusing on probably on a daily basis, if not hourly, both within our own portfolio and all the deals that we see coming in, are trade outs, right? What are new leases doing on a property and what are renewals, right, of current tenants doing on a property? And there was a good period of time where in a lot of the markets that we saw, there was some negative movement, or as best it was flat. Now we've seen renewals tick back up to that 3, 4, 5, 6% even. And new trade outs are kind of, pretty much flat, or in certain properties in certain markets, new leases are coming in at that, we're starting to see 1, 2% growth. So blended, right? Because a property has both usually, hopefully if it's operated well, 50 to 70% renewal rate, with the remainder being new leases. We're starting to see an average of 1, 2, 3% rent growth again on properties. So that's a great stat. For a while, it was skittish there, property by property, but across the country, certainly the markets that we look at, we're starting to see that rent growth kind of coming back.
And Chris, I want to ask you something. I know you mentioned something, I remember a couple of webinars ago where you were talking about we're almost rooting for the interest rates to sort of stay put while we come in and take advantage of all these deals. And this is one of them. I mean, the discount we're going to share with you guys is going to blow your mind that we're getting this off-market deal for. But that being said, if as we acquire these deals, Chris, what do you think is going to happen when they do cut the rates at some point?
Well, I think that's what's really exciting. What's really exciting is the rates staying elevated created a ton of opportunity, which you alluded to, I mentioned before. But the timing is really perfect for us because we know the macro trends are moving in the right direction. Absorption has been better than people anticipated. Rates are on their way down, even though they're moving down slowly. And 2, 3, 4 years from now, you're going to have the cap rate compression that we've been waiting for.
Yeah, absolutely. So, guys, with that, let's get this webinar slides up. And I want to make sure this chat box is working, guys. First of all, how is everyone doing? Hope you guys have a great Wednesday. Instead of, we usually ask the same question. Hey, where are you guys from? And that's all positive and people will get pumped up. But you know what? I'm going to ask a different question today, guys. I'm going to ask, hey, who went on a great trip or holiday or summer or vacationing? Where'd you guys go? Put it in the chat box. Put it in the chat box. I'm going to tell you guys where I went. I went to Bali and Thailand. Where did everyone else go? We got Grand Canyon. We got Alaska cruise. Wow. Orlando. Hiking in the Georgia mountains. Great. Barcelona, London, Dublin, Miami, St. Martin, Phuket. Okay, another Thailand person. Japan, Coney Island. Dude, people have been traveling. Chris,
Yeah.
I know you're on holiday actually now, but we pulled you in for the webinar. Where are you at right now?
Yeah, I'm in Izmir, Turkey.
Oh, wow, fantastic. So guys, good. What we're going to do, guys, is we're going to go through this webinar. It'll be tight. We're going to present you the information. I think you'll be excited. I think you'll understand the multifamily dynamics, and then we'll go through the actual deal. It's unique, right? You're essentially getting a development brand new deal with none of the risk and all the upside. So it's going to be exciting. And at the end, I want to leave enough time where you guys can ask us all the questions. Easy, hard, medium, everything. And we want to just be out there and give that all to you guys. And then at the end, there'll be opportunity, obviously, to book a call with my team. So let's rock and roll. Okay, so a quick little one-liner about me. My name is Vikram Raya, for those of you who don't know me, or this is the first time we're meeting. I'm a cardiologist by training, physician, and I really, enjoyed my field. I started exploring real estate just as a passion, as a hobby, and I really fell in love with it. And this is almost over 14 years ago. And then I slowly started increasing my portfolio and eventually met my partner Ravi Gupta, and we started Viking Capital in 2015. And the whole point was we wanted to give high income professionals really a way to diversify outside Wall Street, as well as, take back control a little bit of how they invest, diversify their portfolio, and become more tax efficient. It's pretty obvious. Obviously, if you invest in stocks, it's there's a tax there, and obviously if you get a W-2, there's some certain amount of tax implications. And so we wanted to figure out other strategies where you can get a strong return without having all the tax consequences. And so that's what really led us to create Viking Capital. And we've been on a journey. We started our humble roots in Atlanta, Georgia. The reason is, even though we live in DC and the company's based out of Northern Virginia, DC, I grew up in Atlanta. I knew Atlanta very well. I knew it was an emerging market, and that's where we got started. And we had, roots down there in terms of professional team and network. And from Atlanta, we just spread and we went to surrounding states. We did Nashville. We've done obviously DC. We went up to Indiana. Started going, they say go west, young man, right? So we went, yeah, west. We started in Texas. We did San Antonio, Austin, Dallas, Houston, right? And then now, this year, we planted our flag in Phoenix. If we entered Phoenix earlier, I think we would have overpaid. And I think we're really entering Phoenix at the right time. This is the time where things have come down, but the growth is tremendous. And really, what's the buzzword? Every third sentence in most people's vocabulary right now, AI, right? And I think one of the hubs of AI, we would have to agree with me, is really Arizona. And so that's one of the reasons is driving a tremendous amount of growth out there. And we'll talk about that in our slides. But anyway, that's a little bit of our story. Go to the next slide. And then I want to introduce quickly Judah and his background. He can talk about his story, and then Chris will mention his.
So my background, some of you may have heard before, but happy to meet the rest of you who may be first-time webinar attendees here at Viking. I started on the legal side of things. Originally on the litigation side, quickly moved over to real estate and transactional law. And once I started chatting with my clients about investment thesis, investment theory, talking investment shop with them, I knew I wanted to be on the buy side. Spent a couple of years in capital markets advisory and investment sales before moving full-time into multifamily and then joining Viking Capital about 5.5 years ago. My job here at Viking is to source the deals, find the financing, run the diligence, and get it to closing. This is one that we really as a team source as a company, and I'm excited to bring it all to you.
So my background has been in real estate private equity my entire career, from hotel development to multifamily acquisitions and development. Really, the most rewarding part has been helping build the investor base at Viking and working with all of you. So super excited to meet all of the folks that are new. I want to give a quick shout out to the folks on the IR team. They are in the chat. So Amir, Hayden, Amber, and Cameron are there to answer questions. We're going to be logging all of the questions that you guys ask. So if they don't get answered today, there will be an FAQ with all of those answers. And they'll be dropping a book call link in the chat. So be on the lookout for that so you can book a call and talk with me or someone on my team.
Awesome, guys. So we've met some of the key people on my team. Here's the rest of the team. And again, you really do need a team if you want to play at this level that we're trying to play at, which is the institutional level, right? And we're playing at this level. This is the kind of deal we're presenting to you today would be a deal that Blackstone, KKR, Greystars, this is the kind of deals that they would take to their institutional investors or family office and stuff. But we're taking this deal and bringing it to our investors and people we care about, because we want you to have the same opportunities that these guys, the big cats, do. And so that's why we created a team like this. And each of us has our own expertise. But the cool thing is when we work together, there's a beautiful synergy. So next slide. And, as we're talking about, it is beautiful to see this, 10th year anniversary. Our first deal in Atlanta, we didn't imagine that all of this could happen, but it's exciting to see how everything has unfolded. And part of celebrating a 10-year thing is to understand we've gone through economic cycles and everything hasn't been rosy. There's been bumps in the road, there's been volatility, but we've been able to sustain it, handle it, and succeed in it despite that. So I want to say kudos to the team for being resilient like that. That being said, this is our track record, about 6,500 units across multiple portfolios, multiple metropolitan areas, as I was mentioning. 31 properties acquired. This is our 32nd. $1 billion of assets and 10 years of operations, 24% return to our investors on our exits so far. When we started, there's only like one state that was active, or maybe two states. And then now over the years, we've been able to get a ton of other states involved. And so pretty much now we're proud to say all 50 states in the United States have Viking investors located within them. And so we're appreciative of you guys. We're so glad of the support.
It was fun watching that map fill up, Vic. But I'm glad we got there.
We're
Yeah.
going to have to start adding all the countries of different.
Next international, right? Why multifamily, right? I've been doing a lot of research the last couple of weeks just to get prepared for this and other things. I was saying, like, where do the wealthy people invest? Family offices, institutions, what they call the smart money, right? And I would say probably 25% of most people's portfolio is in real estate of some sort. And then I'm like, okay, then I got curious. I'm like, what type of real estate? And then probably prior to COVID, maybe 2018, pre-2018, it was all, I would say office was a darling, and then maybe multifamily was number two. The tables have turned. There's a huge major restructuring in office, as you guys know. And it may come back, but it's going to take, years, maybe even decades, right? So at this point, multifamily is the highest allocation for most what we call smart money, intelligent money, large institutions. That's where they're placing their money. So I'm like, wow, that's interesting. Why do they do that, right? And here are some of the reasons. There's cash flow, stability, rent growth, hedge against inflation, appreciation, given enough time period. And this is not a luxury, commodity. This is a necessity commodity. Everyone needs a place to live. And obviously you can be profitable upon exit, and obviously you diversify your portfolio. So these are the reasons why we at Viking have solely focused on multifamily. The bill that passed in Congress stopped something called sunsetting. So the bonus depreciation, which is a tax strategy that is allocated to real estate folks, was being weaned off. Essentially 2025 was going to be 40%, 2026 was going to be 20, and then it was been done. There would be no bonus depreciation. With the bill passing, they've unlocked full 100% bonus depreciation. So whatever the normal bonus depreciation you were normally going to get, now you get the fullest amount of that, which is great. So for those of you who end up investing in this project, we're going to give you an estimate of what you can expect. But overall, this increases your tax efficiency on the deal. Over the last couple of years, there's been some dips in rent and then some flat rent growth. And now we're starting to see upward rent growth. That's what the orange line is starting to show uptick. And then the yellow line is showing what's going to happen in 2026, which is going to be a much more dramatic increase. It's relatively unaffordable to buy homes at this point. And so again, increased rental demand is being persistent. There's about almost a $1,600 gap between renting versus buying. So average home price in the country is about $419,000. That's hard for people to afford, especially with some of the volatility or layoffs or whatever that else is going on. And so people are still sticking to rent, and A class, B class, C class properties are all relatively, I think national occupancy, what is it, Judah, 90%, 92%, something like that.
Yeah.
So it's persistent. Yeah, people are renting, and they're not buying because they can't afford to. And as you know, there's a millennial trend. So there are people who are choosing to delay, buying their first home. And so it used to be earlier, right? In your 20s, maybe early 30s, you'd buy your first home. Now it's like closer to 36, 38. And then another spike we're seeing is people who are older are coming back and they're downsizing into apartments. And there are people who, again, in their 20s and 30s who are living in rentals as well. So there's a lot more demographics of people who are choosing to rent. And why would they be excited about renting? It's because it fits into their lifestyle. Millennials, Gen Ys, I don't know all the different generations, but they all have their own little unique things. But they rather have more amenities. They want more experiences and less about a large amount of space. They just want to have more utilitarian use. And so that modern design, attractive amenities, ESG, accessible to metros, that's what they're looking for. And that's the kind of assets that we're trying to find. And so with that, I'm excited to present our 30-second investment offering, which is Avondale Commons, located in Phoenix, Arizona. It's in an area called Avondale within Phoenix, which is just a suburb. It's probably located 15 minutes from the downtown. And it's super exciting. We're getting this completely off market. So here's why we fell in love with this deal. And here's why I think you guys will really consider this to add to your portfolio. Number one, not all off-market deals are created equal, but in this case, this was literally not going through a broker at all. We went because of our personal relationship with the builders. We were able to secure this completely off market, and it's a major, major, major discount. Like this is probably one of the biggest discounts we've ever got on a project. We were able to do this and act very quickly. We showed them assurance that we can take care of this, and also there's no bidding wars, which is very typical in the Phoenix environment. Number two, by us getting this position in this deal, we're essentially getting it below construction cost, which means that our investors are essentially protected because if we end up selling it for what we built it for, that will essentially guarantee their capital and a decent return. We think it's going to go even higher than that, but that's already built in. This is an area that's called the Path to Progress. It's part of a larger planned community. It's there's going to be mixed use, and this is the apartment anchor of the mixed use, and all of that's already being developed, including Starbucks and restaurants and retail. Across the street from this project is one of the largest children's hospitals in Phoenix. Literally across the street. You can throw a football from our parking lot into the parking lot of the children's hospital. As you know, there's a ton of demand. More and more people are moving to Phoenix, especially this part of Phoenix, and there's going to be limited supply. And then we have another project probably 15 minutes away in a place called Peoria. And so the property management company that's going to manage that will manage this. And so there's a lot of synergy, what we call economies of scale. So we can share resources, employees, team members, so we can run both properties very tight. As the economy is unfolding and we're trying to figure out, where things are going, people are moving to safety, right? Banks want to loan to safer projects. Investors want to invest in safer projects. We want to buy safer projects. Well, guess what? This is a safer project. So that's the flight to quality we're talking about.
Here's our offering summary. So total units 324, build price over 122 million, nearly 123, debt 67.2 million, total equity 55, almost 56 million, interest rate 7.5%. Our hold period is 5 years. On the left side is the total cap stack. On the right side is going to be relevant to this raise. So 25.5 million in total Viking equity, which will make 19 million in Class B and just over 6 million in reserve class. We're really getting an amazing cost basis, as Vic mentioned. We're acquiring at 286 per door, as opposed to the nearly 380,000 to build new, which represents a 21% discount, almost $30 million.
The question is why. So maybe Judah, you want to explain?
Yeah,
like
absolutely.
why?
So, I mean, I'm sure a lot of our investors and people on the webinar have seen in the news and remember back in COVID, right? This is a new construction deal that is just finishing construction the end of this summer. Typically, it would take 2.5 years project of this quality, the stature, finish levels, amenities, which puts you going back 2.5 years, kind of just towards the end of COVID, where there were supply chain disruptions, right? So that's one factor. Additionally, the original developer sponsor team took out a construction loan, now going back even before construction, 3.5 years ago, without a rate cap. So it was a variable rate construction loan. And without a cap, as rates kind of went up 3, 4, 5, 6 points, so did their debt service. And a lot of the money they had built in for reserves ended up going to debt service. So when there was any sort of disruption in supply chain, costs went up. They simply didn't have the capital to get it done. And the project slowed down. Fast forward to right now, the loan's coming due. They have an additional kind of secondary loan on the property as well. All are due. They need to put a new loan in place. They need to finish the construction, and they need a lot more capital to do that. We're coming in and using our money, putting it basically ahead of the previous money. So again, our basis is the new loan, which is a much lower leverage loan at a fixed rate, plus our equity. And that's where we stand in the capital stack. So that's a much, much more secure position below the cost of construction. So just because we're kind of taking the white knight position and helping this deal to fruition and then running the lease up and then managing it for a period of probably 3 years after lease up, we have a fantastic opportunity to buy a below cost property, manage it, lease it up, create an additional value beyond construction, but get a basis below construction. This may sound complicated to some of you. It may sound obvious to some of you. Our team's here for that. Chris' team's here for that, to explain it to anybody who needs to explain it. This is a little atypical from our typical deals, only because it's really that much more advantageous.
So basically, Judah, we're taking this deal over a steep discount because of just the capital dislocations in the market. And we're taking advantage of that and helping, but also having the opportunity to get this at the right basis, which is the key. So that's awesome. So
And you're really getting a hybrid. So typically to get a property this new in this area, you're getting a construction deal with zero cash flow over the hold period. Here, you still have a lease up period, so cash flow is not going to start immediately, but there will be cash flow over the deal, and lease up is going to be underway in the next couple months.
Yeah, put another way, in order to get a brand new building, typically you have to build a brand new building, right? You have to start with the dirt and end up with a new product. Now we do that, we do it on other deals. There's a lot of value to create, but obviously there's a lot of work and risk that gets involved that has to be priced in. Here, we have the opportunity to walk in to a nearly completed, brand new top of line construction, benefit from all the value and lease up, and go ahead of people who were in before us. So it really offers the best of both worlds.
So here, going over the business plan, as we mentioned, we're going to start lease up in the next month or so. Operations is really going to take over. Our property management company is going to be working with the developer during lease up, finalize staffing, vendors, and management systems, put in the rent strategy, and really focus over the first couple of years of retaining renters, increasing occupancy.
yeah, there's gonna be 4 phases, guys. Phase 1 is really finish up, like I think it's 98% completed. After that, as the lease up happens, it's really getting renters in. Once they come in, then it's really then optimizing rents, which is going to be phase 3. And then at that point, we run it, manage it very well, and we look at exit and refinance at that point. And this is the timeline that Chris will or Judah will talk about.
Yeah, exactly. As Vic mentioned, the groundbreaking happened December of 2022. You can see where the first equity raise was, where the delivery of units closer to where we are today. We're going to get through stabilization. We're going to be raising the capital for the new fixed rate loan and getting through stabilization with a projected sale date of 2030, which gives it enough time to build the NOI needed and also navigate to a time where cap rates are favorable for exit. Okay, so the investment structure. So for those of you who are familiar with Viking, typically we have 3 classes, Class A, Class B, and Reserve Class. For this deal, due to the stabilization period and the lack of immediate cash flow, the 10% Class A, no back end Class A structure is not available on this deal, but we do still have Class B and Reserve. Class B is going to have a 7% preferred return and an 80-20 profit share, with the LPs getting 80% and the GP getting 20%. The minimum investment for Class B is $50,000. Reserve Class, you're getting a bump, 8% preferred return, and you're capturing 10% of the GP's profits. So you're getting a 90-10 split. The minimum investment for Reserve Class is $500,000. Here we're going to go over the capital stack. So you can see the current equity in the deal. So these are the original investors in the development of this property over the last several years, $30.25 million. Then you have what Viking's bringing to the table through this offering, just $25.75 million. And then the debt structure, $67.2 million. The total purchase price is going to be $123,205,000 with the debt and equity seen here. Class B and Reserve that we went over on the previous slide, you can see the preferred return, 5-year hold, the equity multiple for Class B, 1.89%. It shifts to 2x for Reserve Class, getting that extra 10% of the promote split. The average cash on cash over the 5-year hold is 6.9%. And the average annual return for the respective classes are here, 17.87% and 19.78%. Here we're going to be walking through both a Class B investment and a Reserve Class investment. So one thing to keep in mind is that because of the stabilization, we anticipate distribution starting in the beginning of 2026, so January of 2026. When that begins, you're going to start out with a 3% cash flow and trail up to 7% over year 5. Here you can see what the annual distribution would look like on a $100,000 investment. And then at disposition, we expect the 80-20 split to yield $54,850 on that same $100,000 investment, getting you your 1.89% exit or $189,359. For Reserve Class, you're getting the same cash flow, but with a $500,000 investment, you're getting an increased amount. And the equity split is a little bit more significant, $321,944, which is closer to your 2x return.
It's important to note on this slide that if you just jump back for one quick minute, the last 2 years, we are projecting to make 7% returns. Our projections right now actually include a higher cash on cash returning on those years. It's 4 or 5 years out in the future. We anticipate kind of building a cash reserve for those last 2 years and releasing it probably in the form of bonus distributions. So we're trying to be a little conservative here. Now, we are actually in our own internal projections projecting higher, but I mean, this is a really good return structure. And for those of you following other deals, the last few years here are definitely kind of higher than you'll see elsewhere in some of our other offerings.
So here we have the sensitivity analysis. Really, this is showing the target exit cap rate. And as you go expand and compress that cap rate, what it does to your IRR, equity multiple, and average annual return. This is specifically for Class B. And the next slide will be for reserve class. Quickly, before I hand this back over to Judah, I do want to mention, we do share the model. And I usually do a performer review where I go through and walk an investor through the entire model. So you are going to have in-depth analysis on how we arrived at this IRR, equity multiple, average annual return. Please book a call with my team or shoot us an email and we'll get those things over to you in the next few days.
What Chris is really alluding to is essentially, I know a lot of you guys have, some people are more big picture oriented, some people are more like location oriented, some people are more number oriented. So those of you who really want to understand the numbers and where all this came from, we've been doing this for almost a year and a half now. We literally take every deal and we break it down in detail, and then we release that as information for you guys. And so we're one of the companies that are probably the most transparent out there. So we want to share that information, so it will help you in your decision making. And so Chris does that really powerfully with usually another investor that we take it from. So I think it's going to be very unique and very helpful for those of you guys who want to really dig in.
So this is the pro forma you've seen on a lot of our webinars. The big difference here is I don't think you've ever seen a big of a jump between year 1 to year 5 NOI. And that's because we're walking into a building that is already built, but not leased up yet. So what we will be doing in the forced appreciation, which we will be working through on this property, is lease up, right? And that's really a multi-year process. There's the initial lease up, where you might be offering some sort of concessions to those moving in. And then there's, as you'll see on the top lines, that goes down as you optimize for top of the market rents, stabilize with efficient operations, and prepare for exit. So here, we've never created this much value on an as-built product before, and it really is a great opportunity for Viking. And again, a lot of numbers here. Happy to walk through any of our investors who want to better understand them. Okay, the loan here at $67.2 million is actually less than the loan in place now, because what we're doing is we're bringing a lot of our money to help what's called right size the loan. In other words, reduce leverage. This is the initial financing. That's a construction loan, fixed rate. That's why it's 7.5%. That's going to get us through lease up, after which we're going to put agency financing on it. In order to make sure that we are not risking a cash in refi of any degree, significant degree, we are reducing the loan that's in place now to minimize the risk, reduce the risk, take out a lot of the uncertainty, so we can execute our plan of not only leasing it up, but stabilizing it as well. So we're walking into a fixed rate loan, 30-year amortization, only interest for the first 3 years, and after which will be in an agency loan once stabilized, take us through that optimization until exit. Here's a great property description to those of you who are the construction junkies out there. This is a very well-built asset. As Vic mentioned, the pool is not in. The pool's actually in. I saw it there. It's not filled with water yet, but we're very close to completion. Really top-of-the-line construction, a developer that we've worked with before ourselves, a developer that is already built in Phoenix and has long-lasting properties to prove that. And feel free to revisit this slide for any details on kind of the construction quality. The amenities here are phenomenal, right? Not only do we have the typical gym, the pickleball courts, the pool, kind of the common area, hangout rooms in the clubhouse, but we're talking about state of the art, right? There are EV charging stations, and there are also more EV charging ports that can be built in the future. This property is really expecting, especially given the tech hub surrounding this property, to be on the forefront. So we are prepared for, if we had 75% electronic vehicles on this property can handle it already. So it is here and ready for the growth. Billiards room, theater room, controlled access. We buy a lot of properties. There are some properties where I say, I could live here tomorrow, and this is one of them.
I was joking with the team, Judah. I was like, hey, maybe we should have like a couple of units, like Airbnbs or something, or like just like open units for like investors and for our Viking team, whoever want to visit Phoenix. It's like a luxury condo, basically.
It is. It absolutely, it's going to attract that kind of tenant, which is what we're interested in. The units themselves, hard top, really modern aesthetics. nice cabinetry, plank flooring. There are different floor plans, there are apartments, there are townhomes. There are really a lot of options for tenants. And again, the idea is to not just, we know they're going to be good tenants in this market, it's how we get them in our property. Top of line amenities, really top of line finishes is how we'll get them there. Again, a good rent profile, tenant profile, floor plans. We're about half 2s and 3s, and the other half 1-bedrooms. We expect there to be a large concentration of kind of young professionals, kind of just past that phase where they're sick of having roommates and they want a 1-bedroom, and we'll have plenty to provide them. But additionally, just given kind of the good nature of the area, and there are some growing families as well, we expect the 2s and 3s to be equally as competitive. Again, you have apartments, and then you have these triple-decker floor plans in the townhomes with garages, 1-car garages, 2-car garages, really, really nice units, competitive in the market as well. We keep going. This is a great map right here. The left side is our property. The right side, the developer already owns the land. They're already under construction. You have retail in the forefront, already a Starbucks lease in place, going to be a Starbucks drive-through. There's a Wing Snob as well, and they have other leases out in negotiation now for really high quality retail. Walking distance to our property, continue to just drive more attention development to this area. And then you'll have mixed use on top. Right now, hospitality and perhaps a small office property as well. It really all this lends to a really nice master plan, mini master plan, I call it, area, giving our tenants the ability to basically have some of these retail spots at their disposal while we won't have to maintain it. And again, we're coming in at about closer to $280 a door on an hour basis. Again, this thing gets sold for just the price construction. We're going to see a good return on our investment just at that number. This is expected to sell well beyond the cost of construction, which is why the discount we're getting is a phenomenally reduced risk position. There's really no better way to come into a construction project after it's built and below the cost of construction.
And the way to think about this is, many of you guys live in nice parts of the country. A luxury condo in your area, what would it cost? Probably, 300, 400, 500 million, maybe. Again, we're getting this for $286,000 for 2025 construction. So just some in Phoenix, so you got to that's sort of how you reference, hey, is there value here? I think there is.
Yeah, and just looking at the rent comps here, we sit in a very nice position. We are probably one of the nicest properties in the area, if not the nicest and newest. Yet there's still upside to be gained through good management. There's no really way to make our units nicer. We don't need that much cushion like we would have in a typical value add project, where we want to see hundreds of dollars room above us, because here these are already finished products. So the fact that we are sitting here competing with those 3 properties to the left, I think we're nice in those properties, yet they're charging more rent, meaning we have some cushion here and some safety. And as I spoke about, some good leases already in tow with the retail and the hotel. There's medical office nearby that'll pair well with the Children's Hospital across the street. So this is really becoming, the development you want to see around you is already in action, already being leased, and we're just happy to be a part of it.
The type of people we expect to inhabit this property are going to be families, tech, workers, semiconductor, manufacturing workers. It'll be nurses, doctors, techs kind of thing, and then probably people in education, right? Ed and med, as we like to call it. So that's probably the compilation of the tenant group.
Yeah, and this is a really good description of the path of progress. Like in some of the other projects that we bought, we've been really squarely in that path of progress. You go out of the property, you turn one direction, and you see a ton of recent development. You go a little farther, you see a lot of development that's maybe a few years old, and you walk out of our property, go the other direction, and you see stuff that's in the works. So here you should have a lot of stuff within 5 miles of the property. It's easy to throw a map out there of all of Phoenix, show you all the great things Phoenix has, but not all of that drives this property. Here you have really great developments, really good attractions, all within immediate proximity. And this is the Boulevard. It gets $2+ million a year. There's a sports complex. There's kids activities. There's a great place to eat, all within a short distance to our property. Again, this is when you have amenities of being in a great area that you don't have to pay for. These are going to drive the kind of tenants that we're going to be looking for. Think of the kind of tenants who are going to be eating at the breweries, at the nicer cafes, and that's who's going to be living in our property.
Yeah. So
this is the hospital that's across the street. It is a large hospital, nationally ranked. You can see in U.S. News, locally ranked as being the main children's hospital in Phoenix, and it's across the street, and it's growing. Like many other hospitals that you may see in your hometowns, some of those major hospital complexes always have a crane in the air. There's always development. we expect to be able to provide apartments to many of the residents, perhaps some of the doctors, certainly a lot of the other staff coming down the line. Hospitals, as Vic can tell you, are mini cities, right? There's a whole economy within a hospital and they need housing. So we've found success previously in providing some of that housing in the immediate vicinity, and we expect to be able to replicate that here as well. And that may sound familiar because I said that approximately 4 years ago when we were under contract to buy what was then called Main Street Village, as we've rebranded to Elevate on Main in South Bend, Indiana. Again, this was a property across the street. I think Vic said that time that you can throw a football to that hospital, and it's no different here. So we found success there. We've seen doctors, we've seen residents, we've seen nurses, we've seen tech living in our property because we're very close to the hospital they work in. And not just anybody captures those tenants, but by providing the kind of apartment life and high quality home that we provide, we've been able to attract the top tenants in the market. And when we're near a hospital, that's what we do. And these are things that we've typically looked for in a property and that we see here as well. We see the rent growth, we see the good paying jobs, we see the job growth, we see a market that despite having high incomes, you still have a high percentage of renters. And all that carries through to Avondale as well. These are kind of some of the ingredients that go into the special sauce when we are looking for our acquisitions. And demographics, again, we have average household income of over $100,000. We have extremely high traffic counts going by this property. What that means, it reduces our leasing costs. You don't need to blast online locators and online ads when you have almost 250,000 people driving by your complex every day. I'm sure all of you in your neighborhoods know all the apartment complexes on the main roads. You don't need to look them up online, whereas the ones in the back roads, a little harder to find. Young ages, still a good amount of families, very low unemployment. So again, this is basically another way of phrasing what was the last slide of all the positive demographics, which contribute to a successful apartment community.
So we've talked about a lot of the existing retail job growth centers that exist already, but I think what's really exciting about this area, as you're looking at the path of progress, is what's coming. The amount of investment dollars that outside companies, big multinational companies, and the city is really developing this area and supporting it. So the next 8-9 slides are really going to go in and show some of the things that are coming to the area that are really going to create jobs, especially the high income jobs. So you have the Avondale Tech Hub in the vicinity, $1.5 billion of investment. This is going to create 150 new jobs and a $5 million in annual tax revenue. This is a huge one. The Taiwan Semiconductor Company is deploying $100 billion in the area. This is going to create so many jobs, and it's going to create the jobs that you need to satisfy new construction that has higher rents. A $65 billion project with 12,000 jobs, the Halo Vista. This is another investment from TSMC.
And just to reiterate, because of the Trump tariffs, companies are being incentivized to not build outside of the US and to build in the US. And so TSMC was planned to have a Japanese chip manufacturing plant, and they decided to scrap the Japanese one and build the one in Arizona first.
Right. Prioritize it and build it quicker because they want to get it in there. You have a huge adventure park coming just 4 minutes away.
You can see like the roller coasters, I mean, like in the distance from the apartment complex. So that Mattel park is like sort of a mini Universal Studios kind of thing.
Yeah. And then you have a lot of growth that's being incentivized by the city. So the city itself is investing $15.8 million and a $9.5 million expansion for the police department. Big grocers, Sprouts, creating a new headquarters, more than 180,000 square feet, which is a $4.4 million project coming to the area. And this is coming in 2026. This isn't coming several years down the road. And Avondale's, it's really becoming a medical quarter. So you have 4 different hospital systems in the area, really bolstering the economic fortitude of the area. NASCAR, $500 million economic impact for the Phoenix Raceway.
And then again, this is in Avondale, not necessarily Phoenix, like greater Phoenix. This is Avondale proper.
Yeah, a lot of these are right near the property. So an Avondale Logistics Center with 300 plus jobs, $670 million investment from Nestle, $27 million investment from Coldwater Depot through a logistics center. and the Cubes at Glendale. Ashley Furniture Home Store is building a huge distribution center, 1,200 jobs, $100 million investment. This is just $11 million from the apartment.
Some of you guys were worried about absorption and oversupply in Phoenix. Well, again, the most recent Phoenix is one of the number one net absorption of multifamily units. That is because what creates absorption, what creates people wanting more demand of apartments? It's jobs, it's people moving in. So positive net migration, number one. And number two is a lot of jobs. There's an insane number of jobs now happening in Phoenix, probably anchored by like the tech sector, right? The semiconductor manufacturing, the logistics components, obviously tourism, the medical sector, education. I mean, all of it gets stacked. I was surprised to find this statistic. Supposedly, Phoenix is the fifth largest city in the United States, number one city in multiple sectors. Next. So the population of Phoenix has grown, four times the national average. 2040, they think it's going to hit closer to 9 million. So it's really starting to really take off. Next. And the interesting thing is you've heard all this job growth, job demand, and companies moving, people moving in here. Then you've heard the population again growing, but combine that with, hey, Phoenix itself has three restrictions on building more things, more apartments, more land, because one, I think I saw some comment about groundwater and water access. So because of the water access, there's only certain areas where they can supply water to, and so that's limiting how much construction can happen in Phoenix. Number two, there's Native American reservations all around Phoenix where you're not allowed to build. And number three, there's a lot of mountains where it's not feasible to build as well. So those natural restrictions, so decreased supply, a ton of increased demand, what's going to happen to valuations and prices and rent growth. Here's the top employers: Banner Health, which is a major medical center, 55,000; Amazon, Honeywell, American Express, St. Joseph's, Arizona State, all of them, Wells Fargo. So the CHIPS Act was passed, I think, in 2022, maybe 2023, and it was really passed by Congress to essentially protect us from the technology race we're in with China, where we need to start creating our own chip capabilities. And so there was, I think, a $50 billion allocation for manufacturing facilities all around the United States. Probably up to 50% of that allocation is probably in Phoenix now. And so Intel, Taiwanese Semiconductor are really spearheading all the growth of that. With my physician background, everyone knows the Mayo Clinic. It's one of the top clinics in the world. And obviously, outside of their Mayo Clinic, in their headquarters in Rochester, Minnesota, this is the second major facility for them, which is in Arizona. $4.7 billion impact, this specific clinic. Tons of higher education, University of Arizona, ASU, and all down the road. Amcor is a chip manufacturing, $2 billion multi-phase investment. So this is interesting. This company, SoftBank, is a technology company, and they put together a proposal, and they're in early stages of trying to build a $1 trillion AI and robotics complex. Essentially, it's going to be the top robotics AI complex probably in the world, and they're projecting it to happen in Phoenix, and so they're in early stages of discussions of that right now. Amazon expanding its footprint. Phoenix Sky Harbor is becoming a busier and busier airport. 130,000 passengers a day, 1,200 flights, $44 billion impact. State Farm Stadium hosted Super Bowl, 24 billion in economic impact per year. The Cactus League is interesting. This is where essentially the summer leagues?
Yeah, these are the West Coast teams play their spring training.
Yeah, so all the spring training happens in Phoenix. So it's like a thing where people who love baseball all come and they rent, or they get houses or Airbnbs or whatever, and they hang out here, and it really drives a ton of economic movement.
You essentially have half of Major League Baseball living in Phoenix for 3 months.
Yeah. Lucid Motors, and electric vehicle manufacturer, $100 million impact. They're also manufacturing their newest vehicle. I think it's called the Gravity. That's their SUV that they started manufacturing here again in Phoenix. Again, Phoenix is also trying to take on Las Vegas as a resort destination, so they're building some resorts. And this is very close to our property as well. The tourism that's already there in Arizona overall. That's the case. And, before I talk about how you can invest, it's really about what is this deal about and what does it entail and why is it interesting, I think, for you guys as investors. It's essentially you're buying something new for a used price. You're buying a Ferrari for like a used BMW. You're able to essentially take a deal which has zero cash flow, and essentially it's going to have cash flow in the next 6 months. It will start having cash flow and it will keep steadily escalating over the hold period. The other thing is you're buying built in $30 million of equity, which is hard to do and is highly unusual, and it essentially deleverages or de-risks the investor. And then really no construction or entitlement risk, but you're getting all the benefits of a new development. And finally, you're capitalizing on these dislocations in the market, right? These are the deals where you just wait and wait and wait, and when you finally find that really good deal, you know how they say you make money when you buy, not when you sell? This is that. This is when you made your money when you're buying it right like this. And so that's my interpretation of why, I really like this deal. I think my team would agree with me on that. And if you wanted to join us, which we think this is going to fill up, and I think a lot of people are already showing interest in it, but there are multiple ways to get involved. Self-directed IRA, you can invest yourself, or you can combine with other folks and get better economics and create a fund. You can invest cash or savings, self-directed IRA or 401ks. If you're part of a trust or you have a trust, you can use that to invest. And if you have a sale of a deal, 1031, for example, you can bring the 1031 and exchange it into this, potentially either this deal or some of the other deals we have. So great. In summary, 324 units. Avondale is a submarket within Phoenix, which is a affluent suburb, 2025 built, 17% IRR, 21% average annual return, up to a 2.2 equity multiple. It's open to accredited investors. We're excited to talk about it. I think we have time for some Q&A. So you can shoot an email. You can scan the QR code. I'm sure my team is dropping some things in the chat box. So please reach out to us. The next steps are really, if you're interested, start chatting with our team so we can answer your questions, make sure you feel comfortable, make sure we can walk you through everything. And then if you're ready to go, let's roll. Let's start with some Q&As, Chris and Judah.
Yeah, absolutely. We can kind of go through the list. I want to remind everybody that we are capturing all of these questions. We're going to answer them. We're going to send out a Q&A with the answers to all these questions. So we might not get to every single one tonight because there's quite a few, but we're going to answer a lot of them live, and then we'll give you your time back and get the rest to you in a report. So the first one from Wendell Scott, Judah, this one's for you. Why is Avondale Commons being sold so soon after construction?
Yeah, so it's not technically being sold. We're acquiring the majority interest, which means we're, as Vic paraphrased, we're taking over the deal. There's a group in the deal now that, as I mentioned before, has come into a bit of a predicament, just given where they've spent their cash, given how the debt service increased when rates increased. So it's not for sale, but essentially they're at risk of losing all their capital if someone doesn't come in to bring it to completion in terms of construction and lease it up to stabilize operations as a multifamily property. So we are acquiring a majority interest. This property was not on the market. It was not for sale, but we were able to acquire the majority interest to kind of make it into a Viking deal.
Judah, the way I think about it is it's like it's a beautiful deal, but a distressed seller. We're essentially buying the deal from the seller. They're staying in the deal, if you will. It's sort of like a seller financing, but they're not getting anything in terms of profit or upside. We are taking pretty much all of that. And so that is essentially the encapsulation. We can get into more details, on a one-on-one call, but that's how I think about it. It's like, hey, great deal, great location, great everything, but the seller had some challenges, and we're able to not only help but take advantage of it for our investors.
Absolutely. And feel free to reach out to my team. There's a book a call link. We can go through the structure with you and explain exactly how the waterfall works on a one-on-one call. Be much easier. Piggybacking on the way Judah broke down that last question, Anita Gupta, is this a ground up build project? Yes, it's recently constructed. We're coming into it in lease up. So wrapping up construction, going in through lease up. So you're really getting the benefits of a construction project, but you're getting cash flow over the whole period, and you're not taking on the majority of that construction risk and entitlement risk that comes with a new development deal. Talk about economies of scale. What does that mean for this project, and how does it pair with the Peoria Gateway project that's our deal?
Yeah, great question. So when I hear the word economies of scale, what I mean is like, hey, how can I use all my resources in the location to make everything all the properties in that location like sing better or thrive. And it's really because two properties very close by, same management company, joining of resources, even like material costs, renovations, whatever we need. We have multiple properties. If you just have one property, then everything is devoted to that one property, and it's you can't share with the other property. So what it allows us to do is essentially both assets get to benefit. Probably we get cost savings, efficiencies, management, technology packages, you name it. It's all there.
Absolutely. I'll take this one from Marcos Headley. Will the investment be an individual unit or a percentage of the complex? And the way that I think is best to think about this is you're buying shares in the operating company that is going to own this property. So every dollar that you invest is going to equal a certain amount of shares. And then there's an equity waterfall that determines what your return is. And that's what we build our model off of. So for more detailed information on how it's structured, reach out to my team. I'd be happy to go through this with you one-on-one.
In addition to what Chris is saying, I would say you are owning the asset. Definitely you're owning the asset because you're getting bonus depreciation and you are owning an asset in the deal. But the way we constructed is through shares.
Okay, that's a perfect segue into this question. On the bonus depreciation, when and what years will it be expected on this project? Also, can this depreciation be used to offset IRA distribution withdrawal taxes? Can it be used to carry back on taxes to 2024? Is there a limit on how much depreciation a passive investor can take, i.e. taxable income, for example? So I'll try to answer these in order. This project will be going into service this year. So it will qualify for the 100% bonus depreciation. Because it didn't go into service last year, if you had a tax filing that you hadn't filed yet for 2024, you wouldn't be able to use the losses on a previous tax return. Whereas, like if we would have put this property into service in December of 2024, you would be able to do something like that. So this one's not going to qualify for 2024 taxes. Using depreciation to offset IRA distribution withdrawal taxes, I mean, always consult your CPA on how this could be paired with IRA withdrawal taxes. But my understanding is yes, there is a use for depreciation to pair with your IRA. And is there a limit on how much depreciation a passive investor can take, i.e. taxable income, for example? And no, there isn't a limit. And you are able to accrue this depreciation and bank it and use it when you need to in the future. It doesn't just expire. So for more detailed information about depreciation, and you'll be getting an email from us when we finish our preliminary cost seg on this, reach out to my team. Happy to go through this one-on-one as well. What is the occupancy rate now? Right now, the property is being completed and we're about to start lease up. So the occupancy rate is 0, but we'll be giving detailed updates on how lease up's going, and reach out to the team to chat about how the lease up process works and what the timeline looks like.
So let me just stack on that. So yeah, this is essentially they're putting the finishing touches on this beautiful property. Lease up is going to start in the next couple of weeks. Really, it's going to go full force to where we're going to make that's why we're asking for a little bit of grace period on the distributions. So then by January time, we should have a strong lease up where cash will start happening. And then what happens is that's first round of lease up. Second round of lease up is second round of leasing is really lease optimization, right? We got people in, now we have to take the rents from that level to we're the most competitive in the market.
This next question, and I know Judah, I think you've answered this several different ways already. Curious why they are selling below construction cost. Okay.
They're selling, obviously their preference is not to sell and not to unload the property. They wanted to hold on to it due to a combination of delays, debt, volatility, and timing. They're in some sort of distress, and sometimes it's just what it is. And so we have relationships with the builder, and he came to us and saying, hey, there's this opportunity here if you guys want it, where we will essentially give you guys this deal at a steep discount, and you guys will take essentially ownership of the deal, and obviously we'll stay in. And their hope is just to get their capital out. Our goal is to 2x to potentially 2.5x your money. That's essentially it. And this is not just this deal. We're seeing this across the country. We find these unique dislocations in terms of price, supply, demand, seller challenges, and we come in and take advantage of this. And so probably prior to 2023, Viking didn't do that many off-market deals. Since 2023, I think we've done a lot of off-market deals. And I'll let Judah, who's our acquisitions vice president, really comment on that more.
Yeah, just kind of to summarize, the goal that we always look for in every deal is some sort of asymmetric risk reward. And that's really what this comes down to. By working with a group who finds themselves in some kind of financial distress with a property that looks near done with construction, ready for lease up, what it needs is a capital infusion to finish the construction, pay for the refinancing of a new loan, and then get the property through lease up, because obviously before you have tenants paying, you have to pay for the operational expenses. We have the opportunity to take the primary position, the senior position ahead of the prior group and in a better position in the capital stack. You might have heard us in past webinars talk about replacement costs. We're happy if we can find a 20-year-old property that we can get below replacement costs. Here, we're getting a brand new property below the replacement cost, which is the cost of construction. That asymmetric risk reward, reduced risk, given the property is already built, but still with the reward of bringing it through lease up and having the opportunity to grow that income from zero to the millions of dollars that you saw. That's the reward. So that's the unique position we find ourselves in, kind of being able to play the white knight to kind of save this deal, but taking it over and putting ourselves as our own equity investors ahead of the in-place investors. They're happy to just be able to get their money back, and we're happy to have a phenomenal deal to bring to fruition.
Great. Thanks, Judah. Here's another question, Vic or Judah, you can answer it. How saturated is the Phoenix market, and what does that do to rental rates? When will leasing start on this property?
Great question. So if you follow the news, there was a lot of development in Phoenix for a good reason, everything you've heard here. And there was some overdevelopment. If you go to the east side of Phoenix, you go to Scottsdale, you go to Mesa, you go some of kind of the ritzier markets, high-end markets that were in the news headlines for the last 5-6 years, those saw a bit of overdevelopment. Here, they didn't see that overdevelopment, right? Glendale sits between kind of downtown in some ways and this property, not necessarily some of the best areas. So this didn't see that natural flow that led to overdevelopment that the east side saw. The conductors, the jobs that we described surrounding this area is what's driving the growth. It's really a natural supply and demand, job demand growth that's kind of fueling the more purposeful construction and is not party to any sort of oversupply that you see on the east side of Phoenix.
And then, I don't know if you saw the statistic, but, maybe 2 or 3 years ago, there's probably some oversupply. But at this point, Phoenix has incredible amount of absorption going on right now. So we track those numbers very carefully. And so there's absorption obviously means that any supply is being leased up very quickly. And so Phoenix is the top city in the country that has the highest absorption at this point.
Yeah, and just to stack on top of that, when we were out in Phoenix for the groundbreaking of our development project, Peoria Gateway, the CEO and the COO of Pegasus, our property management company, came out to the groundbreaking, and we all walked this property together as we were trying to figure out if we wanted to make this our next acquisition. And even though there is a lot of supply in the area, we build really reasonable and conservative lease-up strategy around putting this together. So we're not expecting for this to lease up in 6 months and that it's just going to be fully occupied. We take into account all the supply that's in the area and have been very thoughtful about how we're going to roll this out. We can talk about this further on a one-on-one call. How much capital is needed to complete construction? When do you expect the cash flow? What's the timeline? So just to make clear, the capital that Viking's infusing into this deal isn't just to complete construction, it's also to right-size the loan. The total amount of equity that we're bringing to this deal is $25 million. We expect cash flow to begin at the beginning of 2026, so January, best case, worst case, February. The timeline for closing, we want our funding deadline is set for August 29th. Okay, how long will it take to get reasonable occupancy to break even in the first year? So I guess, Gina, maybe if you want to touch on what the lease up strategy is, or where we expect to be within a year of the lease up strategy.
Yeah, we have an 18-month lease up game plan ready to execute on once the loan gets refinanced. And that's to get it to about stabilized occupancy of a little north of 90%. Call low 90s. That's not break even. So break even, we should hit probably about 12 months in. Again, Chris mentioned cash flowing to investors come January. So that means we're north in excess of debt service around then. So probably somewhere within that first 6 to 12 months, we should be at that break even point.
So, guys, these are amazing questions and they keep coming. And this is fantastic. But just due to the timing and just being respectful of you guys and the amount of time you devoted to the webinar, we're going to start wrapping up here. I encourage you guys to book a call. Like, we really want to individualize this deal for you and your investment strategy and what makes sense for you and your family. So click the link, scan the code, email us, but let's get on a conversation with my team. Chris has created an amazing team, Hayden, Amber, Cameron, and himself, and they're really well versed to handle all your questions and really get you what you need so you can help decide and move forward on the project. This will obviously get filled up as a lot of our previous projects get filled up pretty quickly. Of all the previous projects, this is one I'm super excited about because of just the value that we're able to pass on to our investors. So I'm excited, I'm pumped. Hopefully you guys can join us on this project. So please click the links, book a call, and talk to our team. And with that said, Judah and Chris, any parting words?
I'm excited for everyone to take a look at this one. This one's certainly unique.
Yeah, clearly we're both very excited. As you mentioned, this is a unique deal. I anticipate having a lot of one-on-one conversations with everyone that joined the webinar. Thank you so much for joining. We'll get all of these questions compiled and answered, and anything that you think of, just reach out to our team. We're here to help everybody understand how this works, where the risks are, where the soft spots in the deal are, and hope to talk to you soon.